You've probably felt it for months now, right? There have been these tremors just beneath the surface of the financial world. Stubborn inflation, some strange cracks in the bond market, and just this general sense of unease. But lately, it feels like the market has stopped whispering and started shouting. The prices are telling a story, and today we're going to break down exactly what that story is.
So, this is the real question on everyone's mind. With all this wild volatility in stocks and investors scrambling for solid ground, it feels like something big is just around the corner. They always say the market is a forward-looking machine. It has a knack for sensing what's coming long before it ever hits the headlines. So, what on earth is it sensing right now? All right, so to figure out what's on the horizon, we have to start at the very epicenter of all these tremors, the U.S. Federal Reserve. The Fed did something recently, and they did it very quietly. It's the catalyst for almost everything else we're seeing. And yeah, they tried to downplay it, but believe me, it's having massive repercussions.
$38 trillion. I mean, just let that number sink in for a second. This number hangs over every single decision the Fed makes. It's the U.S. national debt, and it has put the government and the Fed in a terrible, terrible trap. See, they have to keep interest rates low. If they don't, the interest payments on that debt would literally swallow the entire federal budget. But as we're about to see, holding those rates down comes at a very, very high price.
And this is the statement that lit the fuse. The Fed announced it's going to start buying up short-term government debt again, and the official story from Chairman Howell was, and I quote, "just a technical adjustment." He's trying to make it sound like routine maintenance, like they're just checking the pipes. They're being so careful with their words here.
But the market? The market isn't buying that explanation for 1 second. While the Fed is saying technical adjustment, the market immediately heard quantitative easing. Guys like analyst Peter Schiff called it out for what it is right away. The Fed is desperately trying to avoid that phrase because it just screams crisis and money printing. But, you can play with words all you want. It doesn't change what's actually happening.
So let's be crystal clear about what we're talking about. Quantitative easing, or QE, is a fancy term for debt monetization. It means the central bank is basically firing up the printing press for the government, creating new money out of thin air to pay the bills. They are literally turning debt into cash. And that has profound, and I mean profound, consequences for the entire economy. And most importantly, for the value of the money sitting in your bank account. Think of it like this. When the Fed decides to print, it's not just one little thing. It's like tipping over the first domino in a long, long line. It sets off a chain reaction that directly hits the value of your savings and your ability to buy pretty much everything. Okay, so this slide shows that domino effect perfectly. Let's walk through it. Step 1, the Fed just creates new digital dollars. Poof! Step 2, the total supply of money expands. And look, basic economics tells us when you increase the supply of anything, its value goes down. That's step 3. This means every single dollar you have saved now buys a little less. Step 4, this isn't some abstract concept. It's a quiet theft of your purchasing power. And the worst part? Step 5. It creates this vicious feedback loop, because as the currency gets weaker, the government has to print even more just to keep the lights on. Okay, so people aren't stupid. They see the writing on the wall. With this reality of currency debasement now completely out in the open, where is the smart money going? How are real, tangible assets reacting? Well, the market's verdict is coming in loud and clear. We are seeing a major flight to safety in physical assets. Wow. I mean, just look at these numbers. They tell you everything you need to know. Gold, the classic safe haven, is up an incredible 64% for the year. But look at silver. It has more than doubled, up a staggering 113%. And then there's Bitcoin, which for years people have called digital gold. Well, it's actually down 5%. The market is making a very clear choice, drawing a big, fat line in the sand between physical assets with thousands of years of history and the more speculative digital ones. And this quote from Alistair MacLeod, man, it just nails it. This gets to the very heart of why people are flocking to gold. It's not an investment like a stock. Gold is money, real money. And here's the crucial part. It has no counterparty risk. Its value doesn't depend on a government's promise or a company's earnings. In that sense, the gold price isn't really going up. It's just a stable anchor that's revealing how fast the value of the dollar is sinking. Okay, counterparty risk sounds like some complicated Wall Street term, but it's actually super simple. It's just the risk that the other guy in a deal won't hold up their end of the bargain. You own a stock? There's a risk the company could go bust. You own a bond, there's a risk the government could default. You have money in the bank, there's a risk the bank could fail. But physical gold and silver, held in your hand, zero counterparty risk. And in times like these, that distinction is everything. All right, as amazing as gold's run has been, we have to talk about silver. Because what's happening there right now is something truly special. It's not just getting a toe from gold, no. Silver is at the center of its own perfect storm, a truly explosive combination of factors all hitting at the exact same time. So, let's break down the ingredients of this storm. First, you've got a massive demand shock, a huge part of that coming from India's big push into green energy. Next, bam, a supply shock, as China signals it plans to hoard its own supply. Then, add on top of that a surge in monetary demand from investors all over the globe who are fleeing their own failing currencies. And all of this is crashing into a market that was already in a supply deficit for years. It is getting squeezed from every possible angle. And hey, this isn't just theory. This is what's happening on the ground. This quote from Jason Jessup, the CEO of Magnum Mining, says it all. For a lot of these mining companies, silver used to be just a nice little bonus they found when they were digging for other stuff. But now, at these prices, it's not a bonus anymore. It is becoming a primary driver of their profits. It's changing the entire game. This is where things get really, really interesting. Check out this historical parallel. You're looking at the blueprint from the 1970s bull market. Step 1, gold broke out to a new all-time high. Step 2, in the 2 years that followed, silver went on an absolute tear and dramatically outperformed it. Well, what are we seeing today? It's tracking that historical playbook with unbelievable accuracy. You know the saying, history doesn't repeat, but it often rhymes? Well, right now, it is rhyming very, very loudly. So where does that historical roadmap lead? Based on that precedent from the 70s and today's even stronger fundamentals, a lot of analysts like Peter Schiff are now pointing to this number, $100 an ounce for silver. And honestly, given the explosive move we've already seen, it's starting to sound less like a wild prediction and more like a question of when, not if. Okay, let's pull the camera back for a second and look at the really big picture here. Because this isn't just about one metal or one market. This is a story about massive, long-term economic cycles that all seem to be reaching a critical turning point at the same time. All right, check this out. It might sound a little weird, but stick with me. This is the Benner cycle. It's a forecasting tool developed way back in the 1870s by a farmer who just studied price cycles. The crazy part is, look at how often it's lined up with major market tops. The 99 tech bubble, the 2008 financial crisis, the 2019 panic. According to this cycle, the next predicted major high, a time of potential crisis, is 2026. We are stepping into that window right now. And this is where the historical parallels get, frankly, a little scary. The source material draws a direct line from our situation today. Massive government debt that can never be paid back and a central bank forced to print, to the situation in Germany in late 1921. That was right before the infamous Weimar Republic hyperinflation. And the critical point here is the politicians back then weren't evil. They were trapped. Their only politically survivable option was to keep the printing presses running. And that decision led to the complete and utter destruction of their currency. Sound familiar? And that brings us right back to the beginning, to the final and most important question. The warning lights are flashing everywhere you look, from the Fed's money printer, to the historic moves in precious metals, to these long-term cycle indicators. All the evidence we've covered today points towards some kind of fundamental reset of our financial system. So the only question that really matters now is, are you prepared for what's coming?